All right, so this is a continuation of the Chapter 5 XYZ problem. And we did part A in the other video. So that part's done. So computing XYZ's income tax liability. Well, that's fairly straightforward, but we can do it rather quickly here because all we need is the taxable income. So times our tax rate. And we know our tax rate now at the corporate level is 21%. And if we look back to part A, our bottom line taxable income, and so what that gives us then for a tax liability is $392,356. Okay? All right, so part C, so we did part B. So part C asks us to complete their Schedule M1, all right? And so let's do that, but let's note that our Schedule M1 reconciles book income to taxable income before the dividends received deduction. Okay, so that's important to remember. And so we're just going to go through and we're just going to write out, or I'm just going to write out the Schedule M1. And I'll explain where I get each entry. All right, so net income per books. We were given that, all right? Federal income tax provision is $400,000. Now, where did we get, okay? So that's item 2. All right, so then 3, we have our excess of capital losses over capital gains, okay? And so now we're just pulling out these items before, okay? All right, and then any income subject to tax that was not recorded on the books. So this would have been income that is taxable, but that is not recognized for book purposes. We didn't have anything that qualified, but one example of this might be an advance payment for a service. So you would have to recognize that income for tax purposes, but you wouldn't have to recognize it for book purposes until it was earned. Okay, so item 5 is a whole category of things, and these are expenses that are on the books that are not deducted on the return. Okay. And so what are we doing there? I don't have it in here. We're going to have to go get all of the items where our book deduction or our book expense was larger than our taxable expense. Okay, so these are, and we're going to look at the difference of these things. Okay, so, well, let's just run down the list. And these are, so for us, depreciation, the adjustment for depreciation is 0 because our tax depreciation was larger than our book depreciation. All right, but what about charitable contributions? Well, remember that we adjusted our charitable contributions down for tax purposes. We have this carryover. And so, whoops, our book contributions were larger than our tax contributions. Meals are always going to be an issue if we had meals because they're only 50% deductible for tax purposes, but we get to deduct the whole thing for book purposes. So our stock compensation for our incentive stock options. And then we had bad debt expense. And we have warranty expense. Oops. And then we had so really once you do your book to tax adjustments from Part A, you just have to know kind of where to go with those things, how to organize those things for your M1. Okay, because we're not really calculating anything new. We're just figuring out how to categorize things. And then we got to add all those up. All right, now in line 7, item 7, we're going to do income recorded on books, not included in tax return. Okay, we did income subject to tax, not recorded on books, and then we had expenses that are book related, but not tax related. Now we're going to have income recorded on books, but not included in the return. We had some tax exempt interest, and then we had our equity method income of $100,000. All right, and then 8 is deductions on this return So now for section 8, you're going to go and look at your adjustments and all of the places where you had to increase your adjustment, all of the things that were a favorable adjustment for tax purposes, those things would go here. Now, I say that there is one exception, and we already talked about it, but hold on. And remember, our contributions carryover was was larger for book purposes than for tax purposes, so that's zeroed out. So now we're just kind of totaling things up. And then line 10, this is very important. This is going to give you your income, and that's going to go on line 28, page 1 of your 1120, and that's just going to be equal to line 6 less line 9. And when they say line 6 and line 9, they're talking on this form. So here's 9, and then 6 is up there. All right. And then when you take line 6 less line 9, you get okay, and you'll notice that does not match taxable income. All right, taxable income is equal to that minus your dividends received deduction. So taxable income is equal to, and we already knew this because we found this in part A, but I wanted to make sure we understood why what we found in part A does not completely reconcile to our taxable income. All right, and that is it for part C. I will do the estimated income tax portions in another video. That amount, if we remember back in the problem, we have this $400,000. We can call that, and it's called that, provision for income taxes. That's our tax provision. essentially that we were given, and remembering how to categorize them. Remember, we had these capital losses given to us. We're going to go over and we're going to get all of our